Welcome, everyone, to a deep dive into your sources. This week, we're digging into quite a stack of economic reports from the U.S.
Yeah, it certainly felt like a significant week date-wise, June 9th to 13th, 2025.
Exactly. We've got the May inflation numbers, both CPI and PPI, and the latest weekly jobless claims.
It felt like more than just routine releases this time around.
Right. Our mission here is to, take this data dump and really pull out the crucial insights for you. What actually matters? What are the connections?
We want to help you see the picture that analysts are seeing, maybe this potential shift they're talking about.
Okay, let's get started. Your executive summaries jump right into this idea of a palpable shift or a significant juncture. What's driving that assessment? What are the key pieces?
Well, there are really two main pillars emerging from the reports. First, the inflation data, CPI and PPI both, showed a disinflationary trend that looks, well, broader and maybe more pronounced than before.
Okay, broader disinflation.
Yeah.
And the second,
The second is the labor market. The weekly jobless claims data pointed towards a, let's say, discernible cooling, things easing up a bit.
and you could almost feel that ripple through the markets immediately because the reaction seemed pretty strong.
Oh, definitely. U.S. Treasury yields, for instance, they fell noticeably. The 10-year yield dropped about 7 basis points, down to 4.35%.
And the dollar.
The U.S. dollar index, the DXY, yeah, it took a sharp dive, fell to 97.70, which is, I believe, the lowest it's been since March 2022. Quite a move.
And equity markets seem to, breathe a sigh of relief, especially those interest rate sensitive sectors.
Exactly. Growth stocks found support. It all points to this growing market sentiment, this increased optimism maybe about a soft landing.
The dream scenario. Inflation cools, economy doesn't crash.
Right. And it definitely challenges that higher for longer narrative we've heard so much about. Markets started thinking maybe the Fed shifts to being more accommodative sooner than we thought.
Okay, let's dive deeper then. Starting with inflation, from the consumer's perspective, the May 2025 CPI, what did the headline numbers show?
So headline CPI was up just 0.1% month over month in May. And the key thing there is the deceleration, right? It was 0.2% in April.
Okay, slower monthly increase, and year over year.
Year over year, it was up 2.4%. That was actually a little below the consensus forecast, which was around 2.5%. So positive signs there.
And core CPI, the one that the Fed watches like a hawk, excluding food and energy.
Also encouraging. Core was also up just 0.1% month over month, again, slower than the 0.2% we saw in April.
And the annual rate?
Year over year, core CPI landed at 2.8%. Now, that matches the 4-year low we hit back in April, and importantly, it was below the 2.9% consensus estimate.
So slower monthly gains in both headline and core hitting a multi-year low annually. That sounds like what policymakers want to see.
It's exactly the kind of signal they're looking for, that underlying inflationary pressure is easing.
All right, let's unpack the drivers. What specific components push things around in May's CPI?
The big story on the headline number was definitely energy. The overall energy index fell 1.0% month over month.
Mostly gasoline.
Yeah, gasoline prices dropped sharply, down 2.6% in the month, and actually down 12% compared to May last year. That's, real relief at the pump for people.
But didn't things like electricity cost a bit more? Energy services?
They did edge up slightly, 0.4% mom for energy services, mostly electricity, but that was more than offset by falling utility gas prices. So net, energy pulled the headline number down.
Okay. What about shelter costs? Always a big focus, always seems sticky.
Still elevated, no doubt, up 3.9% year over year, but the monthly increase was 0.3%, which was the same as April.
So not getting worse on a monthly basis.
Exactly. And given how much weight shelter has in the index, stable month-over-month growth is actually a positive sign, even if the annual number is still high.
And food prices.
Food overall was up a moderate 0.3% month-over-month. Digging in a bit, food at home also rose 0.3%. Although, interesting detail, cereals and bakery goods jumped 1.1%, mom.
Something to watch there.
Maybe a little pocket of stickiness. Food away from home, like restaurants, was also up 0.3% mom, and that's running at 3.8% year over year. That tends to be harder to bring down.
Now, what about the good side of core inflation, excluding food and energy commodities?
That's continued to be quite subdued, even deflationary in some areas. Core goods were actually flat month on month, 0.0%.
0% change.
Right, and they're only up 0.3% compared to a year ago. The reports mention specific drops in things like used cars and trucks, new vehicles, even apparel prices fell slightly.
So that weakness in goods prices is really helping keep the overall core number down.
It's a crucial factor, absolutely.
Okay, that leaves the other half of core services, but excluding the volatile energy services.
Right. So services less energy services as a whole rose up 0.2% month over month, and that's 3.6% year over year.
What's in that basket?
Things like medical care services up 0.2% mom, and transportation services, which actually declined 0.2% mom in May.
Declined.
Yeah.
Helped by things like airline fares, maybe.
Likely, yeah. The report mentioned airline fares contributing to that dip.
This brings us to supercore inflation. It sounds important. The Fed seems focused on it. Can you break that down for us?
Yeah, it's a term you hear a lot. Supercore basically takes core services, so services excluding energy, and then it also strips out housing or shelter costs.
So services minus energy minus shelter. Why that specific slice?
The thinking at the Fed is that this measure is a really good proxy for wage-driven inflation. It reflects domestic demand pressures and the tightness of the labor market more directly than other measures, because shelter costs can be influenced by other factors.
Got it. So if the broader services less energy services was up 0.2% and shelter itself was up 0.3%.
Right. It implies that the remaining components within that services basket, the actual supercore parts, excluding shelter, likely had an even more subdued aggregate increase in May, probably closer to flat or just barely positive.
And the medical care and transportation numbers fit into that.
Exactly. There are key components of that supercore measure. Seeing moderation there is really critical.
Why critical?
Because if supercore inflation starts to consistently cool, it suggests that maybe the really strong wage growth we saw isn't passing through into service prices as much anymore. It hints that the labor market impact on inflation might be waning.
Which is what the Fed needs to see for sustained disinflation back to 2%.
Precisely. It's a necessary piece of the puzzle for them to feel confident that inflation is truly under control.
Okay, shifting from consumers to producers. Let's look at the Producer Price Index, the PPI. Did it tell a similar story?
It absolutely did. In fact, the PPI report for May arguably amplified the disinflationary signals we got from the CPI. It showed easing price pressures further up the supply chain.
So the headline PPI number.
Headline PPI for final demand rose just 0.1% month over month. That was softer than the 0.2% consensus expected. Year over year, it came in at 2.6%, matching expectations.
And the core PPI, stripping out food and energy again.
That was even more telling. Core PPI was also up only 0.1% month over month, which was significantly below the 0.3% forecast.
And the annual core PPI.
That eased nicely, down to 3.0% year over year. From 3.2% in April, that also came in below the 3.1% forecast and marked the lowest reading since August of last year.
So deceleration in both the monthly and annual core PPI readings. That sounds like a strong signal.
It's a very strong signal that underlying producer price pressures are easing, even before those costs potentially reach consumers. And there's even a core PPI measure, excluding trade services too, that also rose just 0.1% mom. Reinforces the point.
The reports also look at pipeline inflation pressures using intermediate demand data. Why is that important?
Looking at intermediate demand gives you a view further upstream, at the costs businesses are paying for inputs before they produce the final goods or services. Falling costs there can be a leading indicator for lower final prices down the road.
And what did those intermediate stages show in May? Any surprises?
Some pretty dramatic moves, actually, mostly driven by energy again. Processed goods for intermediate demand fell sharply, down 1.5% month over month.
What drove that?
Processed energy prices, they plummeted 8.0% mom. Diesel fuel, for example, was down over 24%.
Wow. And unprocessed goods.
Even bigger drop there. Unprocessed goods for intermediate demand fell 1.8% mom. Again, led by unprocessed energy, which was down 6.6%, with crude petroleum falling 8.7%.
Those are really significant energy price drops further up the chain.
Huge declines, and they often foreshadow lower consumer energy prices later on. Plus, lower energy costs feed into lower transportation and manufacturing expenses for businesses.
Does that automatically mean lower prices for us?
Not automatically. Businesses might use lower input costs to boost their profit margins instead, but it certainly reduces the pressure on them to raise prices, and it supports the overall disinflation narrative coming from the producer side. The core intermediate components were more stable, but the energy story was dominant.
Okay, we've got softer consumer inflation, softer producer inflation. Let's pivot to the other side of the Fed's mandate, the labor market. What did the weekly jobless claims tell us this week?
They added another piece to the puzzle, pointing towards continued gradual softening. Initial jobless claims, so new filings for unemployment benefits, came in at 248,000 for the week ending June 7th.
How did that compare to expectations?
It was a bit higher than the consensus, which was maybe around 240,000 to 244,000. And it was the third week in a row where claims were hovering near the top end of that recent 200K, 250K range.
Suggesting maybe a slight pickup in layoffs.
A potential modest increase, yes. Not alarming, but noticeable.
But the number that really jumped out in the reports was continuing claims, right? People already receiving benefits.
That was, as the reports put it, particularly telling. Continuing claims for the week ending May 31st surged. They jumped by 54,000 to reach 1.956 million.
Higher than expected.
Yes, above the consensus of around 1.91 million. And it's actually the highest level we've seen for continuing claims since November 2021.
And the smoothed out average for initial claims also ticked up.
That's right. The 4-week moving average for initial claims rose to 240,250. That's its highest point since August 2023, confirming that gentle upward trend in new filings. The insured unemployment rate also nudged up to 1.3%.
So putting the initial claims and that surge in continuing claims together,
Yeah.
what's the overall signal?
The signal is pretty clearly one of a cooling U.S. job market. It fits with other things we've seen lately: slower hiring, fewer people quitting, fewer job openings per unemployed person.
Is this the cooling the Fed wants, or is it bordering on something worse?
The reports frame it as early warning signs, not a collapse. It's more like an easing from that period of exceptional tightness we had. It's the kind of rebalancing the Fed has actually been aiming for.
Why is that cooling necessary for their inflation goal?
Because an overly tight labor market tends to fuel wage growth, which then feeds into inflation, especially in services. So a bit of cooling helps relieve that wage pressure. And that's why the rise in continuing claims is viewed as so important.
Okay, explain that link more clearly. Why does a rise in continuing claims, specifically, matter more for wage pressures than initial claims?
It's a good question. Initial claims tell you about job losses. Continuing claims tell you how long it's taking people who lost their jobs to find new ones.
Ah, okay.
So when continuing claims rise persistently, it suggests that finding a new job is getting harder. People are unemployed for longer durations.
And that affects their bargaining power.
Exactly. Longer spells of unemployment tend to reduce workers' leverage when negotiating wages for their next job. This moderation in wage growth is seen as absolutely critical for taming services inflation, especially that super core measure we talked about.
So the jump in continuing claims is a stronger signal to the Fed that things are easing in a way that directly helps control inflation via wages.
Precisely. It suggests slack is building, which should, in theory, dampen those wage pressures that have kept services inflation sticky.
Okay, so let's tie it all together. We have softer inflation data from both CPI and PPI, and now clearer signs of a cooling labor market, particularly from continuing claims. What does this package mean for the Federal Reserve?
Well, putting these pieces together, the data really seems to give the Fed significantly more flexibility. It provides more cover, as some reports put it, for them to potentially consider easing policy down the line.
How does it stack up against their dual mandate, price stability and maximum employment?
On the price stability front, the CPI and PPI reports offer pretty encouraging evidence that inflation is moving closer to their 2% target. That eases the pressure to stay super aggressive.
And employment.
On the maximum employment side, the jobless claims data suggests the labor market is cooling off from potentially overheated levels. That's the kind of rebalancing they've wanted to see. Of course, they have to watch that it doesn't cool too fast.
Right, the risk of overshooting.
Always a risk. But for now, the data seems to align reasonably well with progress on both mandates, giving them more room to maneuver.
And this has definitely shifted market expectations about rate cuts, hasn't it?
Markedly, yes. Market expectations for rate cuts have increased quite a bit. Before this data, maybe the market was pricing in, say, one cut by year-end with some uncertainty.
And now?
Now, if you look at tools like the CME FedWatch, the odds have jumped significantly for the first cut happening maybe by September or October 2025. And there's a strong likelihood of a second cut being priced in by December.
2 cuts this year.
The report suggests markets are pricing in roughly 40 basis points of cuts, which implies one certain cut and a high chance of a second, or even fully pricing in 2 cuts by the end of 2025. It's a big shift.
So what does this mean for Fed speak? How will Fed officials likely talk about this data? Will their tone change?
We'd expect them to acknowledge the positive developments, for sure. But they'll likely stop short of, explicitly promising rate cuts are imminent. They've been burned by inflation head fakes before.
So still data dependent.
Absolutely, always data dependent. But the tone might soften. They might emphasize more that their current restrictive policy seems to be working as intended. They might open the door more explicitly, as one report put it, to cuts if these positive trends continue.
So that higher for longer narrative, it's looking a bit shaky now.
It's being significantly tested, yes. All eyes will be on future communications, especially from Chair Powell. They face a dilemma, right?
Which is?
The data suggests their policies are working, which is good, but their credibility hinges on getting inflation durably back to 2%. So they'll be cautious. We'll really need to watch their updated economic projections, the dot plot, at the next FOMC meeting to see the committee's collective thinking.
Unsurprisingly, all this data triggered some big moves in financial markets. Can you walk us through the reaction across different assets?
Sure, it was pretty pronounced. In equities, the S&P 500 and the Nasdaq Q100 rallied. You likely saw rate-sensitive growth stocks outperforming value as lower expected rates boost the present value of future earnings.
And bonds had a good week.
A very strong reaction in fixed income. U.S. Treasury yields fell broadly, meaning bond prices rose. The two-year yield, which is super sensitive to near-term Fed expectations, dropped quite a bit, down to 3.87%.
Near its lows for a while.
Near the lowest since early May, yeah. And the 10-year yield fell those 7 basis points to 4.35%. This probably meant the yield curve became less inverted, maybe moved towards steepening, as those shorter-term yields fell more sharply.
And the dollar, we mentioned the DXY fell sharp.
Right, down to 97.70, lowest since March 2022. That reflects the reduced interest rate advantage for the U.S. as markets price and Fed easing potentially ahead of or more aggressively than other central banks.
What about commodities? Gold, oil.
Gold likely benefited from the combination of lower yields and a weaker dollar, which are usually tailwinds for gold prices. Oil's reaction was described as more nuanced.
How so?
Well, the weaker dollar is generally supportive for oil priced in dollars, but the signs of a cooling labor market might also raise some concerns about future economic growth and demand, which could cap oil's gains. So a bit of a push-pull there.
Okay, let's translate this market reaction into strategic thinking. How might this data influence portfolio decisions or asset allocation?
Well, the environment certainly looks more favorable for fixed income now. Falling yields mean potential capital appreciation for bonds. So, maybe considering a modest increase in portfolio duration makes sense. Bonds are also looking like better diversifiers again.
And in equities.
There could be a tactical argument for favoring growth stocks over value in this falling rate scenario, but you still want to be selective, of course. Quality growth probably preferred.
And the weaker dollar impact.
That's a potential tailwind for U.S. companies with significant overseas earnings. Those earnings become worth more in dollar terms. It could also make emerging market assets relatively more attractive.
So, time to rebalance portfolios based on this.
The data might justify a review, yeah. Perhaps shifting towards a more balanced stance or maybe tilting slightly more towards risk assets given the soft landing hopes. But, and it's a big but, caution is definitely warranted.
Why the caution?
Because the market seems to be pricing in this Goldilocks outcome, not too hot, not too cold, very aggressively, based on really just one set of encouraging data points.
And that narrative is fragile.
Very fragile. Your portfolio needs to be resilient. What if inflation pops back up? What if the labor market weakens much faster and we get a recession instead? The immediate reaction favors bonds and growth and is bearish for the dollar. You need to ask if your allocation reflects that potential shift, but maintain diversification because Goldilocks can vanish quickly.
That's a really important point. Given the strong positive reaction, we absolutely need to consider the contrarian views and the risks that could derail this narrative.
Crucial to do that. One key contrarian argument highlighted is simply market overreaction. This optimism is largely built on a single month of favorable data.
And data can be noisy month to month.
Exactly. Economic data is volatile. The Fed usually wants to see several months of consistent trends before making a major policy change like cutting rates. There's always the risk the next report disappoints and reverses the sentiment.
The reports also flagged another risk that feels quite specific and maybe overlooked right now: the delayed impact of tariffs.
Yes, this was presented as a particularly potent and perhaps underappreciated risk. It's an important one to consider.
What's the core argument there?
The idea is that businesses that have been hit with tariffs might have been absorbing those extra costs initially, maybe squeezing their margins to avoid raising prices immediately.
But they can't do that forever.
Probably not. The risk is that later this year, maybe summer or towards year-end, they might start passing those accumulated tariff costs through to consumers.
which could push inflation back up.
Potentially, yes. The reports mention scenarios where this could push inflation above 3% by year end. That would completely challenge the current disinflation story the market loves and could force the Fed to stay restrictive or even rethink easing entirely.
So tariffs are a potential nonlinear risk lurking out there.
That's how it was described. It could reshape pricing dynamics unexpectedly and cause real volatility if it hits, especially since markets seem priced for a smoother ride right now.
What other key risks were mentioned that could challenge the soft landing view?
Well, there's always the risk inflation just reaccelerates for other reasons, maybe unforeseen supply shocks, maybe demand proves stronger than expected, or maybe services and wage inflation are just more stubborn than this month's data suggests.
And on the other side?
The risk that the labor market deteriorates too quickly, a sharp spike in unemployment or actual job losses wouldn't be a soft landing. It would signal recession, hitting earnings and sentiment hard.
And the Fed's own actions.
Always a risk of a policy misstep. Ease too soon, and inflation could surge back. Wait too long, and they could cause a deeper downturn. It's a very difficult balancing act. And, of course, external factors like a global economic slowdown could spill over.
That potential tariff impact really does stand out as something that could throw a wrench in the works later this year.
It feels like a key one to monitor precisely because it directly contradicts the smooth disinflation narrative currently driving market optimism and the expectations for a Fed pivot.
Okay, so wrapping up this deep dive, the big takeaway from the U.S. economic data released during the week of June 9th seems to be that the economy is at a really delicate crossroads.
Yeah, that feels right. You have inflation showing clearer signs of moderating, and the labor market definitely cooling. It makes that hoped-for soft landing seem, well, more plausible than it did maybe a month ago.
Key points again: softer CPI and PPI, rising jobless claims, especially the jump in continuing claims signaling more slack, and a market that's rapidly shifted to anticipate Fed rate cuts.
But as the analysis rightly emphasizes, the journey is far from complete. There are still plenty of risks of unforeseen detours.
So we really need to watch the upcoming data like hawks to see if these trends hold.
Absolutely. The next FOMC meeting outcome, especially the updated projections and Powell's press conference, will be huge. And then, of course, the next monthly reports for CPI, PTI, and the job situation in July. Retail sales, surveys, all crucial pieces.
So maybe the final thought to leave you, our listeners, with is this. Is the current wave of optimism, the soft landing view that markets priced in so quickly this week, truly justified by this single round of data? Or is it potentially an overreaction? And could those underappreciated risks, like that potential delayed tariff impact bring inflation back, significantly change the path ahead and catch markets off guard? Something definitely worth keeping in mind as we watch the next chapter unfold.